Welcome to the deep dive. Today, we're diving into a pretty wild corporate story. We're looking at Streamex Corp, ticker STEX. You might know them by their old name, BioSig Technologies. Yeah, you sent over the research protocol, and the core question is just massive, isn't it?
Right.
Can a company that was, practically on life support, huge losses, terrible balance sheet, actually pull off this insane pivot? We're talking ditching medical devices entirely to become a pioneer in gold tokenization.
It's one of the most radical transformations I've seen,
Mm.
and it really forces us to look at this in two distinct parts. There's the old BioSig, right?
Yeah.
Defined by that pure EP platform that just didn't work out financially.
Yeah.
That history really just tells us why they were so desperate.
Okay.
The new Streamex, though, you almost have to treat it like a startup, like a venture capital bet,
Yeah.
just one that happens to be in a public company's shell. And the market, well, it seems to be buying into it, at least for now. The stock's at $6.40 as of September 18th, 2025.
And I think as we dig into the details today, you'll see this isn't really a turnaround. It feels more like a binary outcome, a real flip of the coin.
Exactly. If they nail this, if they actually carve out a piece of this huge multi-trillion-dollar real-world asset market, the upside could be enormous.
That's the downside.
The downside is grounded in that history of financial collapse. It's a very real risk. Classic high risk, high reward. So let's jump right in. Chapter 1, Business Analysis.
Okay, chapter 1. So the backstory BioSig, their pure EP platform aimed at cardiac procedures. Sounded good on paper, I guess.
The tech might have been interesting, but it simply failed to generate significant revenue. Just couldn't get traction.
Mm-hmm.
And that failure is what forced this complete strategic overhaul.
Right, a total shift. So what is Streamex now?
Streamex is positioning itself as a real-world asset, or RWA tokenization company.
RWA tokenization. Break that down a bit.
Sure. Basically, it means creating a digital token on a blockchain that represents a real physical asset. Think of it like a digital deed. In this case, the asset is gold. The idea is that it makes owning gold easier. You can own fractions of a bar, and it makes trading it much more liquid.
Okay, tokenized gold isn't entirely new, though. What's Streamex's specific angle here?
This is where it gets interesting. Their main product isn't just tokenized gold. It's a tokenized yield-bearing gold asset. That's the hook.
Yield-bearing gold? How does that work?
Well, see, normally gold just sits there, right? It's a store of value, maybe a hedge against inflation, but it doesn't generate income. Think gold ETFs are holding physical coins.
Right, passive.
Exactly. Streamex's model involves taking the physical gold that backs the tokens and, through an exclusive partner, Monetary Metals, leasing it out. This leasing generates a target annual yield of up to 4%. And here's the kicker. The yield is paid back to the token holders in gold.
Paid in gold. So your gold stack actually grows.
That's the value proposition.
Yeah.
It fundamentally changes gold from just a defensive asset into something that potentially generates income.
Okay, let's talk about that 4%. In today's environment, with interest rates where they are, you can get decent yields on much safer things like T-bills. Is 4% really enough to draw people into this complex crypto-ish structure from a shaky company?
That is a critical question. And you're right. If risk-free rates are high, 4% on its own might not seem amazing.
Right.
But you have to consider the why behind holding gold. People buy gold often because of inflation fears or geopolitical instability, right? The flight to safety.
Sure.
So if you're already inclined to hold gold for those reasons, getting an additional 4% yield paid in gold on top of that safety, that's potentially very attractive compared to just holding a standard gold ETF that yields nothing. They're targeting that specific investor.
Okay, I see the niche they're aiming for. Now, these partnerships sound crucial. You mentioned Monetary Metals.
Yes, they have an exclusive minimum 3-year deal with Monetary Metals. Monetary Metals handles the gold leasing infrastructure. That partnership is, well, it's essential. It's the engine for the yield.
And the other big one, Simplify Asset Management.
Right. This one is potentially even more significant for distribution. It's currently a letter of intent, an LOI, so not a done deal yet. But the plan is to co-develop regulated financial products like ETFs or ETPs with Simplify.
Simplify is a big ETF manager, right? Over $10 billion AUM.
Exactly. Getting their tokenized gold inside a regulated product like an ETF offered by Simplify, that would be huge. It opens the door to institutional investors, advisors, people who can't or won't directly hold these kinds of tokens otherwise. It's the key to scaling up, potentially.
Makes sense. This RWA market is exploding, over $230 billion already, maybe trillions down the line. But fast growth often brings the regulators knocking.
And that is absolutely the biggest external cloud hanging over this whole thing.
Yeah.
The RWA space is growing faster than the rules are being written, especially in the U.S. The main threat is regulatory uncertainty. Specifically, how will the SEC classify these tokens?
Ah, the Howey test, securities classification.
Oh. Precisely. If these yield-bearing gold tokens are deemed securities, it triggers a whole different, much heavier regulatory framework. That ambiguity, that lack of clarity, is a massive risk. It could completely derail them, no matter how well they execute the business plan itself.
Okay, quite a setup. A unique product, key partnerships, huge market potential, but shadowed by regulatory risk. Let's shift focus now. Who's actually steering this ship? Time for Chapter 2, Management Evaluation.
Right, Chapter 2. And we really need to focus on the new team, the post-merger leadership brought in for Streamex.
Okay, who have they got?
Well, leading the charge is the CEO, Henry McPhee. He's young, 27, comes from a Web3 and blockchain background, so he understands the tech side.
But 27, running a public company, dealing with physical gold, complex finance, regulators, that seems like a potential mismatch in experience, doesn't it?
It's definitely a point of concern, feeds into that execution risk we talked about. But they seem to have tried to balance that. The chairman is Morgan Lekstrom.
Lekstrom, I know that name, resources background.
Yeah, almost 2 decades in global resources. Worked with giants like Freeport-McMoRan, Rio Tinto. He brings that crucial commodity and mining industry credibility. Sort of validates the gold part of the equation.
Okay, so Web3 CEO, resources chairman. What about the finance side? Dealing with Wall Street, simplify.
For that, they brought in Mitchell Williams, a CFA, as chief investment officer. He's a Wall Street veteran, Credit Suisse, Oppenheimer funds. His appointment is clearly aimed at building trust with the institutional finance community.
So it's like a three-legged stool, Web3, commodities, and traditional finance, trying to cover all the bases.
That seems to be the strategy, yeah. Address the different facets of this complex business model.
Now let's talk about something really unusual, their capital allocation. They did a $15 million public offering right after the pivot.
They did.
And they used most of it to buy physical gold bullion for their own treasury. That sounds really weird for a public tech-ish company.
It sounds weird, but within their new business model, it actually makes sense. It's unorthodox, yes, but it's necessary. That gold is essentially their starting inventory.
Ah, they need the physical gold to then tokenize and lease out through monetary metals?
Exactly. They had to bootstrap the whole system. They needed the raw material, the underlying asset, to get the tokenization and leasing engine started. But raising that capital came at a cost.
Which brings us to the dilution. That's a big red flag here, isn't it?
It is. Shareholder dilution has been significant. The total number of shares outstanding has jumped by over 110% in the last year alone.
Ouch.
Yeah. They're basically funding this pivot, including buying that gold inventory, by issuing a lot of new stock. It's like they're treating the public market as their venture capital source. Necessary, perhaps, for their plan, but definitely painful for existing shareholders. And it suggests the cash burn is still really high.
Okay, that heavy dilution and the need to buy inventory sets up the financial picture perfectly. Let's dive into the really grim numbers. Chapter 3, Financial Analysis. And as you said, this is more about understanding why the pivot was needed, not predicting the future from these old numbers.
Exactly. Chapter 3. The historical financials from the BioSig era are, frankly, abysmal. Trailing 12 months revenue was just tiny, $13,000.
$13,000, wow.
Against a net loss of over $26 million, minus $26.25 million to be precise.
So the operating margin must be astronomical in the wrong direction.
You calculated it, it was negative 211,407%, minus 211,000%. It just screams broken business model. It wasn't just unprofitable, it was a cash incineration machine.
Okay, so the P&L was a disaster. What about the balance sheet? That sounds like the core of the bear case.
It absolutely is. The balance sheet fragility is stark. The company has negative shareholder equity, a deficit of about $3.5 million.
So liabilities are greater than assets. On paper, they're insolvent.
Technically, yes. If they had to liquidate everything tomorrow, the assets wouldn't cover the debts, shareholders would get nothing, and creditors likely wouldn't be made whole. There's zero asset cushion, none.
And short-term liquidity, how are they managing day-to-day?
That's where it gets even more alarming. The current ratio, it's incredibly low, 0.03.
0.03.
Yes. That means for every dollar of bills due in the short term, they only had about 3 cents in current assets readily available to pay them. It signals a severe acute liquidity crisis. That $15 million raise wasn't just for gold, it was likely essential just to keep the lights on and avoid immediate collapse. They were walking a financial tightrope.
Okay, so with financials like that, negative earnings, negative equity, Trying to value this company using traditional methods like PE is pointless.
Completely useless. PE is negative infinity.
You mentioned a discounted cash flow or DCF model earlier, giving a speculative range of maybe $8 to $12 per share. How much faith can we put in that?
Very, very little faith. It's purely an illustrative exercise. To even get a positive value from a DCF, you have to plug in some extremely aggressive assumptions about future growth, assuming they capture a big chunk of that RWA market very quickly.
And they'd have to use a high discount rate too, right? Because of the risk.
An extremely high discount rate. We're talking 20%, maybe even 25%, to account for the immense execution risk, the financial fragility, the regulatory uncertainty. So that $8 to $12 range, it's not a prediction, it's not a price target, it's just a mathematical outcome if you assume everything goes perfectly according to a very optimistic plan, discounted heavily for risk. Take it with a huge grain of salt.
Right. A foundation of financial ruin, zero cushion, massive risks. Yet the market seems to be looking past that, at least somewhat. How is that possible? Let's get into Chapter 4. Market sentiment.
Okay, Chapter 4. The market narrative is definitely focused on the future potential, not the past wreckage. We see this in the analyst coverage. It's thin, not many analysts cover it, but the ones who do have a consensus rating of strong buy.
A strong buy with that balance sheet.
Yep. And their average one-year price target is $10. So analysts are buying the RWA story and the potential scale-up through Simplify.
What about the stock chart? Technicals.
The technical picture supports that bullish sentiment, at least recently. The current price, around $6.40, is trading comfortably above both its 50-day moving average, which is about $5.46, and its 200-day moving average at $4.91. So there's been strong positive momentum since they announced the pivot and the new strategy.
But is everyone on board? Is there skepticism out there?
Oh, definitely. There's a significant counter-narrative reflected in the short interest. It's sitting at 9.16% of the float.
Almost 10%. That's pretty high.
It is. It shows that a substantial portion of the market is actively betting against this turnaround. They see the financial fragility, the execution hurdles, the regulatory clouds, and they think it's more likely to fail. They're shorting the stock, expected the price to go down.
Okay, so a split view. Bullish analysts and technicals, but significant short interest. This makes the ownership structure even more interesting. Let's move to Chapter 5. Ownership structure. Who's actually holding this stock, and does it tell us anything?
Right. Chapter 5. And this is where we find perhaps one of the most compelling arguments for the bulls. It centers around one specific, very knowledgeable insider, Frank Giustra.
Giustra, the Canadian billionaire, mining, resources, entertainment mogul, that Frank Giustra.
That's the one.
Right.
He's a renowned entrepreneur and financier, particularly famous for his success in the natural resource sector. He understands commodities, especially gold, extremely well.
Okay. So what's his involvement?
He didn't just offer verbal support. He put significant personal capital into Streamex after the pivot announcement. In July and August of 2025, he bought 179,605 shares.
How much did he invest?
Just under $750,000.
Oh.
$734,724.
Wow. So a guy who made his name and fortune in gold and resources is putting his own money into this yield-bearing gold tokenization company built on the ashes of a failed MedTech firm.
Exactly. You can see why that's such a powerful signal. It's not just management telling a story. It's an external, highly credible expert in the underlying commodity, essentially endorsing the model by investing his own cash. For many, that might be the single strongest bullish indicator. It suggests the core concept leasing gold for yield has structural merit.
That's a major point. What about the rest of the ownership? Is it concentrated?
It is quite concentrated, yes. The top 25 shareholders control about 47.35% of the company.
Nearly half the company in just 25 hands.
Right. That kind of concentration can lead to higher volatility in the stock price, sure.
Yeah.
But it also often means there's a core group of investors with significant skin in the game, likely aligned for the long term, waiting for that big potential payoff rather than trading in and out.
Okay, Giustra's buy-in is definitely a head-turner. Let's try to wrap our arms around all these conflicting pieces now. Chapter 6, risk assessment. Let's use a quick SWOT framework, maybe.
Good idea, Chapter 6. So, strengths. We've got the unique product at yield-bearing gold token, the exclusive partnership with monetary metals for the leasing, and the potential for regulated distribution through Simplify, which is huge. And you could add Giustra's backing as a strength.
Okay.
Weaknesses. This is pretty much all financial, right? Built on the wreckage of BioSig. Negative shareholder equity, technically insolvent. And that critically low current ratio of 0.03, signaling severe liquidity risk, plus the history of dilution.
Couldn't summarize it better. Now, opportunities. Clearly, it's the massive RWA market growth. If they can capture even a small slice with this unique product, especially via regulated channels like ETFs, the opportunity is enormous.
And finally, threats. What are the big external dangers?
Number one, without a doubt, is regulatory uncertainty. What the SEC decides about classifying these assets is paramount. It can kill the whole thing overnight. Number two is sheer execution risk. This is a complex plan blending finance, tech, and commodities, run by a relatively new team with zero operating history in this business. A lot needs to go right.
Makes sense. Any other major threats?
Yeah, partner dependency. Their model relies entirely on monetary metals for the yield generation and potentially on Simplify for mass distribution. If either of those partnerships falters or falls through, especially Simplify, given it's still just an LOI, the strategy unravels quickly.
Got it. What about the broader economy, macro factors?
It's a bit of a double-edged sword for them. High interest rates, like we discussed, make their 4% yield look less attractive compared to safer options. That's a headwind.
Right.
But persistent inflation, or any kind of major geopolitical turmoil, tends to drive people towards gold as a safe haven. That's a potential tailwind. If those macro factors push gold demand higher, a product that offers gold plus a yield could become very appealing very quickly.
Okay, a complex web of risks and potential rewards. Let's try to synthesize this into a final outlook. Chapter 7, Conclusion.
All right, Chapter 7. Let's boil it down. The bull case is really a forward-looking narrative. It's exciting. You've got a massive potential market in RWA tokenization. You have a unique product differentiator with the yield-bearing gold. You have key partnerships lined up. And you have credible leadership endorsed by experts like Frank Giustra. It feels very much like a venture capital investment, high risk but potentially explosive upside. If they execute flawlessly, maybe that $800 speculative range isn't completely crazy if everything works.
Okay, that's the dream scenario. Now, the bear case.
The bear case is firmly rooted in today's financial reality. It's stark. Negative shareholder equity means no safety net. Virtually zero revenue from the new model proven so far. That frighteningly low current ratio signaling ongoing liquidity stress, massive execution hurdles, and overriding everything is the regulatory guillotine hanging over the RWA space. The research protocol was blunt here. There's a genuine possibility of a total loss of invested capital.
So the current share price, around $6.40, it seems to be pricing in quite a bit of that optimistic bull narrative already.
It definitely reflects optimism, yes. But it's crucial to understand that an investment in STEX today is highly speculative. It really is binary. It hinges entirely on them pulling off a very complex, very ambitious plan perfectly, navigating a tricky regulatory environment, and doing it all before their fragile financial situation catches up with them.
They either become a pioneer in yield-bearing RWA gold and the stock potentially multiplies, or they stumble on execution, regulation, or partnerships, and the legacy financial issues likely drag them down towards zero.
That sums it up perfectly. It's a knife-edge scenario.
So here's a final thought for you, the listener, to chew on. Given this binary risk, massive potential versus potential total loss, which single factor do you think is the most critical one to watch over the next 6 to 12 months? Is it the progress with Simplify? Seeing that LOI turn into actual, tangible, regulated products hitting the market? Or is it waiting for the SEC? Getting definitive clarity, good or bad, on how these yield-bearing RWA tokens will be treated, which milestone, or lack thereof, will be the bigger catalyst, something to think about. Thanks for joining us on the Deep Dive. If you found this analysis useful, please do like and subscribe to Stock Analytics AI. And remember, members get priority deep dives. For just $4.99 a month, you get exclusive access as we work through all the S&P 500 stocks in the coming months. Or if you've got a specific ticker you want us to cover as a one-off, just drop us a super fancies.
And just a crucial reminder, this analysis was generated by an AI system based on the research protocol and publicly available information. It's intended for educational and informational purposes only. It is absolutely not financial advice. You must conduct your own thorough due diligence and consult with a qualified financial advisor before making any investment decisions.